Last week, the Bank of England published a formal policy statement outlining a new form of settlement account. Called an omnibus account, this innovation allows wholesale settlement to be carried out between banks using tokenized money on the distributed ledger technology, the DLT. This is a watershed moment for those financial institutions which have been seeking to use blockchain to conduct securities settlements. I have with me today Rhomaios Ram. Ram is the CEO of Finality, a consortium of 15 banks which have created a payment system for wholesale settlement. Now, I know you've got some slides to share with us, Ram, and I will come on to the Bank of England announcement in a moment, and also we can perhaps address some of the issues that were discussed in the previous panel with the Bundesbank. But can you just start by telling us a little bit about Finality? What brought these 15 banks together in the first place?
Absolutely no problem, Chris. And first of all, thank you very much for inviting me. It's a pleasure to be here. There's a little part of me that's hoping that I don't get some rotten tomatoes thrown at me since I was so active in the chat before. But here's hoping that everyone's kind. So,
well, there we go. Just to say, Rom, if you do have questions, please put them in the chat, and I will be the filter. So the tomatoes will hit me first. But any questions for Rom, please do send them in. So I'll make sure that we discuss them as well as and when we go along. But yes, tell us about Finality, please, Rom.
Yeah, no problem, Chris. So actually, let me just share a slide with you. So Finality basically grew from a small consortium back in 2016 of 5 institutions, and the realization that those institutions had. So if you cast your mind back, this was when, maybe a year or two into when everyone was talking about blockchain and how it was going to revolutionize the markets and all of this kind of stuff. And there was a whole bunch of proof of concepts that were going ahead at that point in time. What those 5 institutions realized was that the efficiency promised by blockchain around the asset settlement side would only occur if there was kind of a compatible pay leg. So we started initially as a kind of a project, and the initial goal was basically to figure out the design parameters of such a pay leg. And then that was followed quickly by a feasibility study in 2017, and then 2018, given that it was feasible, would it be investable, etc. We got to the conclusion that it was going to be investable by the end of 2018, and in early 2019, the 15 institutions that you see kind of in front of you decided to invest in our company and sort of help us, be on the journey for developing this kind of future blockchain-based settlement infrastructure. We currently have 15 investors, and 14 of them are banks, and one of them's an FMI.
And these 15 members, 14 banks and 1 FMI, I mean, are they the only ones who are on this in this consortium? And do you expect to grow it? Can others join it and use it? What's the kind of status of the consortia regarding its members?
Yeah, so the eventual goal is that actually we'll have many members. So the eventual economic model that we're aiming for in each jurisdiction is actually a member mutual model where there will be many participant owners. So we fully intend to expand the ownership in the fullness of time. The 15 that are currently invested are the folks that have the drive and vision to kind of get it to a point where others can feel comfortable investing. Frankly, it also makes it easier with a slightly smaller consortium to make progress. Yeah, so we will, in the near future, we'll probably increase the size of our existing consortium, and then as we get more and more currencies on board, fingers crossed, then we expect that others will also join in.
Sure, and I think it's probably fair to say that you've discovered in the journey of launching this consortium from Universal Settlement Coin to Finality that a lot of work is required in engaging with official institutions and understanding the financial market infrastructure. So let's talk a little bit about the announcement last week about the Bank of England Omnibus account. This is an account that commingles funds. And can you just tell us a bit about how you expect this to work? How might Finality engage with this policy announcement in the coming weeks?
Yeah, so I guess the first thing to say is we perceive the announcement as kind of a huge event, not just for Finality and payment systems, but for this kind of concept of DLT being able to add something better to the existing wholesale payments environment as a whole. And we think this announcement, it's like the first time that kind of a preeminent authority has kind of said that, you know, there may be a role to play. So we've already applied for an account, and we believe that our plans dovetail well with the policy requirements. But of course, we'll have to wait and see how that all pans out. So with respect to how it works, it's basically an omnibus account. There's a diagram on the slide that basically shows, it's actually from the Bank of England policy, so it's not our diagram. It shows basically how it would work. The place that we come in is the payment system, where member A is obviously paying member B. And essentially what we're doing is using DLT as a form of accounting system for funds held in the omnibus account. So the beauty of this arrangement is that the participants continue to be the beneficial owners of the funds in the omnibus account. So they're not taking Finality credit risk, which was kind of one of the conversations that was happening in the previous panels. So it means that, you know, obviously Finality UK is bankruptcy remote, and but the way we use the blockchain is basically to record all of the changes in ownership of the funds. It's a very well understood model. These types of accounts have existed in other jurisdictions for some time. You know, in the US, you know, the details are different, but the similar account is the joint account. And in Europe, there is a specific ancillary system technical account that also possesses the same features. So the actual account itself is quite well understood. And in a sense, the main sorry, go on, Chris. Yeah.
Go ahead. I suppose just to address the people who weren't watching, Jochen Metzer from the Bundesbank said that his nervousness was wholesale payments being made, what he called outside the gate, so outside the RTGS. Are wholesale payments being made outside the gates on this slide? Being settled outside?
Well, I guess it depends. Mm-hmm. Yeah, so I guess it depends on how the various authorities view the gates. What I can say is in Europe, this setup basically already exists, and there are systems like Euro 1, run by the EBA clearing group, that basically settle high-value payments. So, you know, it doesn't seem like the problem that Joachim's talking about is insurmountable. And chips is also the same. Chips is also high-value payments.
Okay, so I mean, and when is this ready to go? I mean, is this ready to go now? I mean, this looks like a form of settlement across a single pool of liquidity. It's pretty revolutionary. You've applied for this account. When do we expect to see these sorts of things commence?
Yeah, so I guess I need to dampen expectations, not just on my behalf, but also on you know, the Bank of England's behalf and Her Majesty's Treasury. I think it'll take some period of time. Only because while, you know, obviously applying for payment systems and authorizing them and all of that, all of these things have been done before, and putting all the elements of what we need to go through together, and as Jochen mentioned, you know, doing the careful review of what kind of risks we pose to the system that may or may not be different to what the risks that other systems pose, will take some time, and it's never been done before in a complete sequence. So I think there'll be some amount of time taken on the overall regulatory process. Speaking for us, we also have a little bit of work to do, because we didn't know when this stage was going to be arrived at. We also need to actually set up an entity in the UK and do all of the operational hiring and implementation, etc. That'll take a few months. We obviously completely know how to do all of the technology and have built you know, a functioning version of that. But I imagine as we get closer to hooking up to the RTGS, there'll be more and more kind of non-functional requirements that need to be met, that we'll need to dig into a bit more. So I can't give you a precise time, but I'm hopeful it's not too far into the distant future.
Thank you. Yeah, go ahead.
Yeah, well, no, actually, you go for it.
Well, I was just going to ask about, I mean, when it does happen, I mean, the way that liquidity management occurs will change. I know you've got a couple of slides on that and how you see it. So I'd be interested for you just to talk through that, just so it's because one of the benefits of this is, I suppose, that the liberating of liquidity requirements and the changes that could come as a result of that. So do you want just to talk through that part of it a bit, if you wish?
Yeah, that'd be great. A pleasure. So one of the things that we, just to put Chris's comment in context, one of the things that we kind of market is that we would be able to produce what we term a single pool of liquidity. And you know, like with all of the terms in this kind of new space, it needs a little bit of explanation of what precisely we're talking about. So what you see on the slide is kind of a stylized diagram of how settlement kind of liquidity would need to be split up for, let's say, a foreign institution trying to settle into you know, a domestic currency. So all the stuff in kind of the nice kind of shade of green is what would happen normally on a single jurisdiction with domestic participants, et cetera, et cetera. But when you have a foreign bank that wants to settle, they've actually got to split their liquidity across several intermediaries. So if they're just doing payments, they obviously have a nostro at some sort of correspondent bank. That's our commercial bank too in our representation. They need to maintain liquidity there. Separately, if they're settling securities, they may need to maintain liquidity at a CCP or at their broker dealer. And so what happens is they end up having to, they kind of have to split their liquidity across multiple pools or puddles, I guess, in this case. And that's kind of a problem because it imposes balance sheet costs. Well, there's the pure cost of holding too much liquidity, and then there's all the balance sheet costs associated with it, both from the perspective of the foreign bank and actually all of the people on the other side holding, you know, holding their balances that presumably have to have some sort of overdraft function in case they make payments that you know, aren't covered, et cetera, et cetera. So it's a situation that works right now, but it's kind of suboptimal. Mm-hmm. What we're proposing is, and this the previous panel kind of alluded to this, what we're proposing actually is to allow people, by widening access, to directly interact with their own pool of liquidity. So they only need one pool of liquidity, basically, and then they can interact with all of the other players that they need to interact with. So basically, we start to remove all of the risk of you know, all of this intermediation, and it's the model change, and this kind of goes to Mr. Metzger's point from earlier. It's the model change, the business process change that actually results in, you know, faster settlement with more efficient liquidity usage and fewer parties to reconcile. It's this whole idea of, if you widen the access, you can start to do all of those things much quicker. So I completely agree with the previous comment that this would be possible to do on different technology. This is another way to do it. The way we're proposing to do it has one advantage over existing sort of centralized technology, and that is around concentration of risk. So obviously, if you do this, there's some amount of concentration of risk from a financial perspective. But if you use the setup that the Bank of England's proposing around omnibus accounts and what's already available, you kind of remove all of that financial risk. The second piece is around operational risk. So if you have one operator operating it, obviously the risk is concentrated, the operational risk is concentrated in that one intermediary. If you start to distribute all of the technical operation of those nodes, then you know, it's a way to start to reduce the dependence on any one institution functioning correctly at any point in time. So for us, there's a big resilience question around it.
And just to be clear, so that green box FNPS in the middle there, that is a pool of liquidity on a distributed ledger technology that is the Finality consortium there in the middle, effectively, and it's on a distributed ledger technology on a blockchain. Would you describe it as a blockchain as well?
Yes, yes, it's on a blockchain. So yeah, I'll be a bit more specific. It's a Finality payment system in a specific jurisdiction for a single currency on a blockchain.
Okay, that's very clear. I mean, thank you for going through that, Ron, because obviously we use these terms quite a lot. But that slide is probably the one that makes it certainly clearest for me. And is this argument well understood that distributed, decentralized method of with multiple nodes is safer than centralizing nodes? Is that argument accepted by regulators, by the market participants? Because that is your case effectively, isn't it?
Well, there's two or three different cases going on. So one is can the system be improved by widening access and having an easy way to interoperate, which I'll kind of talk about in a moment, between all of the different systems? Answer, yes. Does it reduce risk? We believe yes, to be TBD from the authorities. If you're going to do that, you can do it on traditional infrastructure, or you can do it on distributed infrastructure. Our view is that you will have two benefits from doing it on distributed infrastructure. One is the resilience point that I just made, and the second one is actually a cost control point that I'll be making a little bit later. When you have a centralized infrastructure, what is the incentive for them to drive down costs and keep fees low and all of that kind of stuff? If you have a distributed one where all the participants are actually running the nodes themselves, they have the incentive to keep all of that stuff lower.
So no, that's three very clear reasons as to why that offers improvements over the current system. I suppose my question was, is that, I mean, allowing more participants in, good, that makes sense. That makes sense to me. Perhaps not everyone feels that way, but I'm not, I mean, perhaps people can sort of ask questions about that in the comment box. I won't, we probably don't need to discuss that any further now, though we can come back to that. You spoke about a very interesting point about how it can be a kind of system of systems, or a network of networks, as it were, where this then interoperates with others. Talk us through that, because this is obviously single currency. You've deliberately made it quite simple, but talk to us about the next kind of iteration of this as there are multiple systems.
Yes. So, so the system I've talked about is the kind of left-hand box, right? So that was what you saw on the previous slide, and it's only one currency. And frankly, if we only did one, oops, sorry. I shifted my my mouse. If we only talked about one currency, I actually think it's not that interesting of a proposition, because actually I completely agree with the people that say that existing RTGS can do all of that stuff. So why would you need it? The time it starts to get interesting is when you start expanding by currency, and that's what you see in the second box. And what we're intending to do is set up independent payment systems in each of our jurisdictions. Right now, we're focused on 5 with the possibility of a 6th. The 5 are euros, sterling, dollars, Canadian, Japanese yen, and actually the 6th could be Swiss. And the idea would we would have an interlinking system between all of them. I think one of the previous panelists talked about interoperability. That's a technical question, technical both from a like IT technical, but technical also from how do you synchronize settlement, finality, etc. We think we know how to do all of that. It's a whole topic on its own, so I won't go into precisely how we do it. But an example of how this might work and why it would be beneficial for someone is, supposing you're a UK bank, you have your natural funding currency is sterling. You can raise funds in it. That's no problem. But you want to do something in the States, let's say. Right now, you need to hold money at a US bank, your correspondent, and then when you want to buy the securities in the States, you need to make sure that the money is sufficient. If it's not, you have to do an FX trade, then it's 2 days later to settle, and then you have to coordinate that with your asset side settlement via all of the different intermediaries that are involved in that settlement. In the Finality world, what would happen is, oh, I need to settle. I've got pounds. I instantly FX them into dollars, and then I instantly settle them against the settlement system that's carrying the securities that you want. So the whole process becomes much easier because you're peer-to-peer and you don't have to reconcile and get funding versus all of the other currencies. The last piece, which is the right-hand column, I've kind of alluded to in talking about the FX thing, is when we can start to interoperate with security settlement systems that are also present within jurisdictional, within other jurisdictions. And so we expect that we'd be able to enable DBP on a bilateral basis, even between basically without the need for a kind of intermediaries, as soon as other security settlement systems that have similar characteristics to ours come online.
Thank you, Ron. These slides make it very clear, actually. So thank you for sharing them. We'll do a few more of them, and then we'll have a question and answer session without slides. And I can see some good questions coming in as well. But the thing that strikes me here really is that you're talking about a degree of disintermediation that is really very far-reaching indeed. I mean, it's a new kind of design for the financial market infrastructure. It's a new there are elements to it that will have far-reaching implications. So just talk to us about this and how you have, I suppose, how this looks once it becomes real. I mean, when you start removing these elements and this system exists, there are going to be some changes that will probably change how we think about financial markets as well. So just talk to us a bit about that.
Yeah, I mean, so in the end, what we think we're doing is actually developing a new design of FMI, to put it bluntly. And we think this FMI has some design features. This distributed FMI has some design features that make it really appealing versus the existing centralized form of FMIs. So if we cast our mind back in history to what FMIs were really originally for, you got to think a few hundred years ago, clearinghouses started to appear to make markets much more efficient and also to lower risk. And that kind of efficiency, transparency, and protection against kind of perturbations by any individual participant were the real function of the FMI. So the rest of the market could continue safely and so on. The issue that we've started to develop, particularly since 2008, when there was a call for more safety in the market versus participant kind of defaults and so on, was we started to concentrate more and more risk into fewer and fewer kind of FMIs. And at some level, we absolutely have lowered the risk of the market overall. But we have exposed ourselves to greater kind of tail risk. So if those FMIs now something starts to happen to them, that's a problem. We've basically created a lot more systemic risk in the system. The other thing that's happened is by centralizing much more, there's less of a control, I guess, around for the participants around costs. So of course, lots of these things are owned by market participants, and they try their best to reduce the cost. But in the end, there's kind of this agency problem of how you run it. And what we're proposing is actually something that basically puts the risk back to the people that create the risk and actually profit from it. And secondly, allows those participants to drive the cost down based on how they manage their own infrastructure and so on. So this is what we think that this new design actually could extend beyond payment systems into lots of other areas. And we think that's quite a potential innovation.
And so I think you've described it before as analogous to the internet, really, with a new governance and efficiency model, which I think is quite an interesting way of looking at it. I suppose, I mean, looking at it from that point of view, is there the evidence that the market participants want this? I can see there's a consortium, there's clearly the technologists want it, and there's clearly a lot of desire to try and make the most of this. And I can really see that, and that you make quite a compelling case for that. But in terms of the less savvy market participants, the buy side, the sell side, the investors, is there evidence that there's a demand for this type of change over and above what we have now?
I would put it differently. The market participants definitely want cheaper, more efficient settlement that allows them to utilize their balance sheets more optimally. That's without question. To be honest, I don't think they really care about how that's achieved, right? Like there could be any number of suggestions about how they get there. And they're obviously open to any methodology that can deliver that change. What we think we're doing is proposing a method. It may not be the only one, but certainly a method that actually hits all of the different points that they're kind of talking about, right? We can make it cheaper, we can make it much more efficient, we enable the optimization of balance sheet, actually from a societal perspective, we actually lower overall risk in the system, the overall financial system. So while we're not claiming that we would be the only system that could do that, or the only way that you could get there, we're certainly saying that this is a way to get there. And we think that there's several elements to it. Part of it is technology to cover the resilience point and this kind of driving costs down point. Part of it's actually much more to do with, as was mentioned in the previous panel, it's really about a different business process and what that enables and how the regulation changes around that. So I'm specifically referring to, you have to widen access to enable something that takes the risk down.
Thank you, Ron. So yeah. Should we just remove the slides now for the last 5 minutes so we can just, we've had a few questions that have come in. I mean, we had, I suppose, one that's slightly cheeky, I suppose, but from the from one of the viewers. I mean, how far does this business model go? I mean, as your slides very, sort of clearly showed that the central counterparties were removed, but then there were still central banks there. I mean, if you take this business idea to its logical conclusion, would the central banks as intermediaries themselves not also disappear?
No, because I don't think there's any way to change the need for central bank money, which is essential for wholesale market settlement, right? Like nobody's going to trust, commercial bank money. Well, maybe they will, but I think it's unlikely that they will trust commercial bank money for settling wholesale financial market transactions. I think you could improve the resiliency of this system, actually, if the central banks decided to take, basically the private keys for issuance, and they directly control the issuance of the tokens on there. But that's, we're a long way from that that situation. And that, then the question is that any different from CBDC? And the answer is no. That is actually CBDC at that point. And the only question comes about who runs the infrastructure. And there could be a debate about whether it's more resilient for the market for the participants to run the infrastructure, via their nodes, or for the central bank to run it centrally. I guess we'd all have our opinion about that.
We would, and I certainly think that the way you describe it there means that the link between the central bank's role is obviously a key part of this, and we saw that with the way the Bank of England made this announcement. Just going back to the central banks, then, with the Bank of England announcement, that is obviously one that is a watershed moment, as I described. But you also spoke about the euro, the Canadian dollar, the US dollar, the yen, and the Swiss franc. At what stage are those other central banks at getting the Finality sort of network of networks to a point where you can advance with those other currencies as well? Is this something where the central banks are working in harmony? Is it something where you have different conversations with each one of them? Tell us a little bit about the flavor of the different discussions with those institutions.
I can't comment on whether the central banks are working in harmony. I mean, I know that they all, they're all colleagues, and they meet on the various CPMI type panels and some things like this. I imagine that they discuss this, but I couldn't say what the level of discussion is. We have bilateral conversations with each of them, and there are many, as was hinted at in the last panel, there is an abundance of caution, because there's elements of this that are quite new. Not the technology is one part of it, but other elements of what we're proposing that are quite new. And there is a accountability for those central banks around the safety of the financial system. So we're working our way through answering the questions that they have as they arise.
Sure, thank you. And I mean, the thing about the Bank of England announcement last week is it was coupled with the announcement of the CBDC project work, and it was with the looking into the idea of digital currency, and there's a joint task force between the British Treasury and the Bank of England on that. What's your view of how these conversations about wholesale settlement are sometimes linked to the CBDC argument? I mean, we haven't spoken about CBDC, Finality not creating a CBDC, but there is the obvious link there. And I'm wondering what the best way of kind of approaching this is in terms of the discussion. How do you handle that? I mean, do you get lumped with a CBDC sometimes? Do you have a particular view on how a CBDC should be part of the solution?
Yeah, so... well, I'll answer the lumped question. So yes, we quite often get lumped with CBDCs, and we quite often get lumped with stablecoins. And of course, we view ourselves as a payment system, so kind of neither of those things. the announcements that we've seen from the Bank of England and most of the other central banks around task forces and various kind of studies of CBDC appear to us to be predominantly focused on retail. So the Bank of England announcement said it was about households and businesses and all of that kind of stuff. And so for us, that the problems posed by something like that are completely different, and the benefits, obtainable from something like that are completely different from what we're kind of talking about. I mean, as well off as I like to think I am, I don't really have balance sheet problems and all of this kind of stuff. So I think, the folks that are worried about how to solve the problems for retail will be focused on different things. So generally speaking, when people ask us about it, we think it's just a different topic, essentially.
Thank you very much. Thank you for explaining that, Rom, and good luck to you and the Finality team as you go about this endeavour. Thank you for all the viewers as well and for the questions that came in. And please stay with us if you are a DMI member or if you've been invited to the invitation-only session, which starts now. You need to click on the Roundtable tab at the top of the Swapcard platform and then click on the link there if you've been invited and registered to the off-the-record invitation-only session, which starts now with the Monetary Authority of Singapore and with Accenture, where we'll be discussing navigating the global token economy. Ram, I expect you'll be in that session Ram, I expect you'll be in that session as well, and I look forward to seeing everyone there in a moment. Thank you all very much.
Thanks, Chris.